Hello, everyone, and thank you for joining us today. Welcome to our inaugural State of the Markets presentation. We're very happy to be sharing some important information with you today via this recorded webcast. My name is David Schlossberg, and I'm the bald guy in this picture. I'll be sharing this information with you today along with my colleagues Jerry Howell on the far left of the picture and the guy with the best smile of the group next to him, Mr. Larry Strelecki. For compliance purposes and to keep the regulators happy, we need to show you this information. Feel free to pause it if you really have an interest in reading it all. Otherwise, I will continue for us today. Today, we're going to be talking about these four topics, and we're going to try to educate you on what we believe and what the financial analysts are saying. While it would be impossible for us to cover every item out there in the economic world, we'll try to touch on the most relevant factors we believe you should know about today. And as many of you have heard many times before, past performance provides no guarantee of future results. So we're going to try to pick up on trends to help guide our decision-making process when investing. Here's what we're going to talk about today. We're going to talk about putting the S&P 500 in its proper perspective. We're going to talk about factors affecting the stock market in 2014, the U.S. economy and what happened to it in 2014, and then I'll be wrapping up with 2015 forecasts. 2015 forecast, rather. 2014 forecast would be really easy for me to do since it already occurred. Anyhow, to get us started off, I'm going to turn the clicker over to Larry and ask him to share about our first topic and how to treat the S&P 500 as a gauge of investment performance. Larry, on to you.
Thank you, David. When you turn on CNBC at night, you hear everyone talking about what the S&P did this or that. The S&P actually returned 11.4% last year. Now you may ask, what is the S&P 500? The S&P 500 is an unmanaged stock index of 500 large American companies that is designed to reflect overall stock market performance in the United States. When you hear commenters talk about the S&P 500 performance, you might be wondering, why didn't my portfolio achieve those returns? Why didn't my portfolio outperform these indexes? Well, the answer is you shouldn't be comparing your portfolio in total to the S&P 500 or any other benchmark too closely, because indexes don't tell the whole story. They don't include any diversification, effects of taxes, or any transition costs. They also carry a lot more risk than most clients would be comfortable with. You might also ask, are stocks overpriced right now? Have we reached all-time highs? While we certainly can't predict the future, we're going to try to answer these questions for you today. Let's take a look at some historical returns since 2007. We thought you might like to see how some other benchmarks are performing. First of all, what's a benchmark? Well, a benchmark index is a standard that you can use to compare the performance of a given investment or portfolio. In the investing world, there are hundreds, if not thousands, of indexes that can be used as benchmarks. The S&P 500, which we've discussed, is a benchmark. The Dow Jones Industrial Average is a benchmark, and the Russell 2000, or small cap stocks, are all used as benchmarks for different asset classes. Now, you can invest directly into an index, but this chart highlights how value stocks perform when compared with growth stocks, international stocks, bonds, as represented by different indexes. As you can see, international stocks and emerging market assets got hit pretty hard this year, while REITs, which is real estate, and the S&P growth stocks did quite well in comparison. Now, the S&P is actually outperformed all other stocks mid-cap, small-cap, and international stocks in 2014. Let's look a little more closely at the performance of different asset classes over time. We'll go to the column 2009. In 2009, you can see the highlighted boxes there are the emerging markets and international stocks that were top performers, returning about 79% and 32% respectively. Emerging market stocks were on fire that year as investors went looking for growth opportunities overseas. However, in 2010, these asset classes were knocked off the podium, and by 2011, they fell to the bottom of the pile. Let's look at another example. In both 2011 and 2012, real estate investment trusts, or REITs that we previously mentioned, turned in the best performance of the bunch. But then in 2013, the asset class didn't crack 3%. In 2014, there was at the top of the pile again, returning 28% of the year. What does this tell us? In any given year, the top, middle, and bottom performers change or rotate. You never know which ones will be the top performer. In fact, the top performer one year can be at the bottom the following year. When you look at the headlines and the market chatter, all you hear about is the S&P 500 is doing this, alternatives are doing that, and it can be frustrating to look at your own portfolio returns. What they don't tell you is that those exact returns are impossible to achieve because they ignore real-world factors like liquidity, can't always get your money out of certain investments when you want, trading fees, transaction costs, taxes, and many other issues. Capital gains are a big deal for investors in today's environment, depending on how long you hold a particular investment. Your after-tax returns could be much, much less than the pre-tax return. Another reason is risk. This is a big reason. If you take a shotgun approach, you won't hit your target all of the time. Sure, looking back, you might have wanted to be all in for 2013 when the S&P returned almost 30%, but how would you feel in 2008? Are you prepared to lose 37% of your portfolio? There's a lot of risk. That's a lot of risk to be taking on. We don't take a shotgun approach. We do a lot of research and choose the options that are right for you and diversify them. Over time, you'll have a portfolio that hopefully performs with less severe ups and downs. You can see that the model diversified portfolio, though it didn't beat the top performers each year, was able to mitigate a lot of the extremes. And a quick note here, this isn't an actual client portfolio. It's just a model created to illustrate a mix of asset classes that you see here. We only build customized client portfolios that include investments that we believe are the correct choice for your unique needs. Since it's impossible to predict with any certainty which asset class will win in any given year, we don't have a crystal ball, we invest in a mix of stocks, bonds, alternatives, and international assets to help iron out the extreme highs and lows over time. The problem is that diversification isn't exciting. It's much more fun to try and beat the index. It's much more exciting to phone up your friends and brag about the hot stock pick you picked that just shot up 400%. Here's the thing. Investing shouldn't be fun or exciting. Our job isn't to have fun with your money. It's to try and help and protect it and grow it so that you can be a good steward of your money. We build portfolios that are designed to help you achieve your long-term financial goals, not to beat an index that isn't accessible in the real world. So what's the bottom line? Don't worry too much about what indexes are doing. You can't invest directly in them, and they exclude the effects of important factors like transition costs and taxes. You can see that a diversified approach that we've illustrated here helps reduce highs and lows, which is why we work with our clients to choose a mix of the right investments for them. Now we have another disclosure chart. You can take a look at the disclosures here and talk and explain each of the index and how we calculated the performance of our model diversified portfolio as well. And this is for your additional information if you so choose. Now that we've discussed the pitfalls of relying too much on benchmark indexes, I'll pass the mic over to Jerry, who will talk about some of the factors that contributed to stock market performance in 2014. Jerry?
Larry, thank you very much. Appreciate your comments. To get started, here's a snapshot of the S&P 500 in 2014. The S&P started 2014 at just under 1850. Closed above 2,000 for the first time in history in August and ended December at 2,058.9. Overall, 2014 was a solid year for equities. Though we didn't have a repeat of 2013's blistering performance, both the Dow and the S&P 500 hit record closes multiple times throughout the year on the back of improving domestic fundamentals. For the year, the S&P 500 returned 11.39%. The Dow grew 7.52%, and the Nasdaq gained 13.4%. However, the road last year was anything but smooth. You can see that there were many short-term dips along the way, as well as some bigger declines. Let's take a look at some of the events that affected market activities. After a great 2013, investors chill in January when emerging markets and currency fears caused a sell-off, but quickly got back on the horse. After several positive months, investors got nervous again in July when the Fed started talking about interest rate increases. You might remember October's big scare when the Dow plunged 460 points in a single day on fears about Ebola and European economic growth. It may have felt like the sky was falling, but within a couple of weeks, stocks came roaring back and climbed to new record highs, just in time to get jittery again in December, when oil prices plummeted. What's the takeaway here? Today's stock markets are volatile, and inter-year declines are quite normal. Even when it feels like the sky is falling, it's more important not to hit the panic button. Sit down, take stock of what's actually happening in the financial markets, and make prudent adjustments where necessary. Improvements in the employment situation contributed significantly to equity performance in 2014. The labor market hit a major milestone last year. It regained the 8.8 million jobs lost in the recession and surpassed them. Now that doesn't mean that we're at total employment. Demographic trends and population growth mean that we are still under ideal employment numbers. However, psychologically, it's a milestone that shows how far the economy has come since the bottom of the recession. More jobs mean more working Americans, and that typically spells stronger consumer spending and a better demand environment for U.S. companies. Not only has the economy recovered all the jobs lost in the recession, but the quality of the jobs has also improved. A big concern in the last couple of years has been that much of the job creation was happening in low-paying industries like food service and retail. Many Americans were forced to take part-time or unpaid work because they couldn't find quality full-time jobs. Well, the jobs are back, and many of them are in well-paying industries like IT, finance, and business services. They're also being created in the manufacturing industry, which is great news for the big industrial centers of the country. These are not low-paying retail or restaurant jobs. These are the kind of jobs that drive the economy. The ratio of unemployed Americans to open jobs is also roughly where it was before the recession. Looking back at the peak of the recession in 2009, you can see that there were somewhere between 6 and 7 jobless Americans for every available job. As of October of last year, that number was slightly less than 2, which is great news for job seekers who don't have nearly the competition for available jobs. Low gasoline prices contributed to last year's performance. From the June average high of $3.77 nationwide, gas dropped to $2.63 in December. To put that in perspective, that's almost $2 lower per gallon than the $4.11 a gallon Americans were paying in July of 2008. The gas you put in your car is probably a decent chunk of your monthly household budget. On average, Americans spend over $2,000 a year on gas. The drop in pump prices put money back in consumers' wallets, giving them more money to spend in other areas like cars, electronics, and other consumer goods. American companies also had a lot more cash to spend last year. As you can see, corporate cash has risen steadily since 2008 and is near record levels. With overall improvements in the economic and demand picture, business started putting the cash to work, building inventories, increasing their hiring, and investing in future growth, boosting economic growth. Economists expect to see this continue in 2015 and think it's an important point in favor of a continued bull market. As we mentioned earlier, investors got jittery about when and how the Fed would start raising interest rates. In this chart, you can see that interest rates have been held near zero since 2008. This low rate environment, backed by the Fed's quantitative easing program, contributed to the stock performance in 2013 and 14. Quantitative easing programs ended in October, and the Fed's next big move will be to start raising interest rates to keep inflation in line with long-term targets. The Fed hasn't given us a clear idea of when they will start hiking rates, but it's not likely to happen before the April FOMC meeting. Though how fast and how far rates will go up is an open question. The Fed has emphasized that they will raise rates slowly in keeping with the economic outlook. The consensus of 50 economics polled by the Wall Street Journal is that rates will remain below 1% until at least the end of 2015. Were investors right to worry about interest rate hikes? History suggests probably not. To put things in perspective, consider what the S&P 500 returned over post-rate hike periods. According to the UBS U.S. Equity and Derivatives Strategy 2014 Outlook Research Report, while past returns are by no means a guarantee of future results, we can see clearly from these examples that interest rates hikes don't necessarily mean calamity of equity markets, contrary to what some naysayers would have you believe. We'll share more specific forecasts about the markets with you later in the presentation. Though the stock market and the economy don't always move in tandem, over the long term, stock market performance tends to mirror the economy. While some folks are out there predicting an end to the bull market, we don't think it's going to end this year. Here's one reason why. Historically, bull markets lasting at least 4 years have only ended with a recession. That is, they'll typically do not end just because everyone is too bullish. Now let's move on to talking about the U.S. economy with Larry.
Thank you, Jerry. Now let's move on to talking about the U.S. economy, where many analysts have called 2014 the year of the recovery. They're now calling 2015 the year of divergence. Now, why is that? Because while the U.S. economy is moving into a sustainable, positive growth phase, other regions of the world are continuing to struggle. Along with improvements to the labor market, the overall financial health of the American households has continued to improve last year. After household net worth declined during the recession, it has climbed above its previous 2007 peak. What does increased net worth mean? It means that home values are coming back up, Americans are going back to work, and then they also have more money in their bank accounts. Households have also unloaded a lot of debt they accumulated in the years before the recession. While it's terrible that many folks lost homes in the mortgage meltdown, it's good news for the economy that Americans in general no longer have to service unsustainable levels of debt. Before the recession, Americans were paying over 13% of their disposable or after-tax income in debt payments, and as of the fourth quarter of 2014, that percent has dropped to just under 10%. Speaking of high levels of debt, one area that we're concerned about is the growing national debt. This chart shows us accumulated federal debt as a percentage of GDP. Going back to the 1940s, we can see that the national debt peaked at 113% of GDP by the end of World War II. Instead of paying it down, the post-war economic expansion allowed the U.S. to essentially grow its way out of that debt over the next decades to hit a low of 24% in 1974. However, you can see that the national debt is growing rapidly again and is projected to reach 74% of GDP in 2015. Now, how much debt is too much for the economy to sustain? There's no real consensus about that, but federal debt is trending in the wrong direction. Fiscally, the nation needs to get its house in order before the debt starts to weigh on economic growth. Now, in spite of the concerning area we just mentioned, the U.S. economic expansion continues to look strong. When analysts and economists start making forecasts about the future, they turn to leading economic indicators that help them project how different segments of the economy will perform in the months ahead. Individually, any given indicator might not tell you much, but by looking at many of them over time, a picture emerges. This chart shows a composite index of 10 different leading economic indicators. By looking at the overall trend in these indicators, we can get some hints about what's coming in 2015. As of August of 2014, you can see that the composite is trending strongly upward with no indication of trouble. Now let me draw your attention to 2 points on the chart. Though past performance can't predict the future, we can look to history for clues. The shaded areas in the chart represent recessions. Take a look at the period preceding the 2 recessions on this chart. Do you see how the index dropped below zero in the months before? That's a big clue that the economy is headed for a downturn. Now, do you see that pattern appearing now? No, you don't. That's because economic fundamentals are trending in a generally positive direction, and this supports continued economic growth in the United States for 2015. Though we're confident that the economy appears to be on the right track, we know that the stock market doesn't always follow the economy. Consumer sentiment is an important indicator of how Americans are feeling about the economy and their financial prospects, and it hit its highest level since 2007 at the end of the year, based on cheaper gas and better job prospects. While this is great for consumer spending, it's also something that concerns us. As you can see from the chart, there are numerous times in the past when consumer sentiment has been down when the markets have been positive. Take a look at how consumer sentiment trends before recessions. Historically, recessions sometimes follow periods of high consumer sentiment. Is that always the case? No, but we can see that wasn't the case in 1977, 1984, or 2004, but you can see that is what happened in 1972, 2000, and 2007. It's something we're keeping our eye on because it's an indicator that the market could trend downward. I like Warren Buffett's phrase, be fearful when others are greedy, and greedy when others are fearful. In spite of many favorable indicators, we continue to be cautious and prudent about managing risk. Now let's talk about inflationary trends for a moment. Inflation is defined as a general rise in the prices of goods and services, and one is the key indicators of economic well-being. Though the relationship between inflation and the stock market is complex, all things being equal, stable, modest inflation is better for equities than high or volatile inflation. Now, if you take a look at the box in the middle of the chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The core CPI, below it, takes out volatile food and fuel prices to focus on long-term inflation needs. You can see that yellow headline CPI line jumps around it much more than the blue core CPI line. And that's because food and energy prices tend to be very volatile in the short run. As of November 2014, the headline CPI was well below historic averages at 1.3%, and the Federal Reserve expects it to stay modest in the months to come, which is good news for economic growth. Though the past isn't always prologue, historically a sudden run-up in prices has often accompanied a recession. Note the huge inflationary spikes during the 70s oil crisis and the 80s recession. These were periods when a number of factors sent prices spiraling out of control, taking years for the economy to cover. Fortunately, it's not a problem we have to deal with right now. Now that we've looked at what happened in 2014, I'll turn it over to David to discuss some forecasts for 2015. David, it's all yours.
Well, let's look ahead to 2015. In doing so, rather than put everything on my opinion, let's see what the chief economic gurus are forecasting for domestic equities in 2015. Here are some of the top investment analysts in the United States and what their target is for the S&P 500 in 2015. And they all expect the S&P 500 to grow this year, and the average expectation is just shy of 7.5% growth. While we want to rely on them, of course, we also understand that we don't try to foretell the future. No one knows for sure what equities will really do in 2015. But that being said, we're also glad to see that many of the leading minds do agree on one thing, and that's that stocks are likely to end the year in positive territory again. Now, we won't be surprised if we see some ups and downs along the way, and we may even see a correction of 10% or more. Ultimately, though, many economists believe the underlying fundamentals look strong enough to support continued growth in the equity markets. So let's take a look at why. We talked earlier about how many people have worried about the Federal Reserve raising interest rates, and this is a report of the Federal Reserve's summary of economic projections going forward 2014, 15, 16, and et cetera. And if we look at the bottom row there, we'll see what the Fed expects the interest rate to be, currently at 0.13, and at the end of next year, they expect that to rise roughly 1% to 1.13, and roughly 1% rises over the next several years thereafter. Predictability is key to avoid a market overreaction, and the Fed has been doing a great job of telegraphing its plays and giving investors time to adjust to the future changes. The Fed also expects the economy to grow at a nice, steady pace, as shown in their forecast of GDP change on the first line. Not too hot and not too cold. So you may have heard a couple pundits talk about the dangers of the S&P reaching all-time highs in the market and how they can't really be sustained at these new levels. However, if you take a look at the long-term trends over the past century, despite some ups and downs during those trend periods, we can see that from 2000 onward, the S&P 500 trend result has been relatively flat, as it has in other historical periods in the past. That's more than 10 years without significant growth, and that same pattern occurred between 37 and 48, and again between 66 and 74. But what happened after those periods is also apparent in this chart. The market experienced extended periods of growth afterwards. Now, while we can't predict the future, Some economists believe that this pattern will continue, and this can be added to the pile of evidence supporting their projected stock market growth of 2015. If you watch the financial news, you'll hear analysts talking about price-to-earnings ratios, or PE ratios. That's a measure of the price of a company's stock compared to its annual earnings. As the price-to-earnings ratio go up, people start to ask if stocks are overpriced. Looking at this chart of inflection points in the S&P 500, we can see that the PE ratios often peak before a drop in the market. The PE ratio in March of 2000 was at 25.6, and when that occurred, we experienced a 49% drop in the market. The PE ratio in October of 07 was at 15.2, and we experienced a drop of 57%. Now, there is a relatively significant difference between the 25.6 and the 15.2% PE ratio, so I'm not sure how much we could count on that. If we look at what the PE ratios were before we had some relative climbs, then those are relatively low at 14 and at 10. The long-term PE average for the S&P 500 is about 15.5. At the end of December 2014, that PE ratio is at 16.2 times earnings. Now, just because we're above the average doesn't mean that stocks can't go higher. For example, take a look at December 96, where the PE ratio was 16 times earnings, and then we experienced a 106% run-up after that. The bottom line is that the PE ratios may be slightly higher than average, but they may not be too high to hope for some continued growth. Although stocks are no longer at the bargain basement prices, many of the pundits believe equities still offer better value than other financial assets and should be outperforming cash, bonds, and inflation in 2015. So looking at average valuation, represented here on the chart on the left by average real earnings yield, which accounts for inflation, you'll see that even when the market achieves its average valuation, there's still often opportunity for growth. If you were to decide that the S&P 500 can go any higher after it reached its average valuation and pulled out of the market, you would have missed out on 49% additional return in 1982 and 83% additional return following 1990. Another thing that I want to point out is that even though the market has grown 204% since 2009, it hasn't even reached its long-term average valuation yet, as measured by real earnings yield. In fact, the S&P 500 has another 22% appreciation available before it crosses that long-term average. This is another argument in favor of the bulls. When you turn on CNBC and you hear that market commentators say that the market's near record highs or at record highs, it may make you think that the market can't go any higher. But a record high doesn't necessarily mean that it's too high. The chart on the right shows that during different periods of time, how often the stock market stayed near its high. Since 2009, the S&P 500 has been within 5% of a record high on 78% of the trading days. And 42% of the trading days, it's been within 1% of its record high. To put that another way, if there were 250 trading days in a year, we would expect to see the S&P 500 close to a record almost 200 days per year. Of course, we may see some dips, and that's normal. Last year, the stock market experienced several minor dips and a couple of bigger declines, as Larry already mentioned. However, history shows that these drops are typical. In fact, the S&P 500 has experienced average intra-year declines of 14.2% since 1980. Despite those declines in a calendar year, the annual returns were still positive in 27 out of 35 of the years. So what does that tell us? Even when we see some retracements of value throughout the year, it's not necessarily a big deal. We should try not to panic, and we should make sure that we have diversified holdings to protect against some of the downside exposure. Well, another interesting piece of history, research would suggest that there's some correlation between the stock market performance and the presidential election cycle. If we look at this chart and we look at year 3, we'll see that since the middle of the last century, 94% of the time that a president was in his third year, the market averaged on the upside, it went on the upside and it averaged an 18% rate of return. The S&P returned a median again of 18% in the third year of a president's term. Now, let's not forget that there are many other factors influencing the market, such as the Federal Reserve, the economy, what's happening overseas. However, some economists would treat this indicator as one more tick in the pro-bull column for 2015. I do want to point out, however, that presidents who are in their second term of the White House can negatively affect the valuations also. Take, for example, 2000 and 2008 in the bottom right chart. Both years were the final year that the president could serve in the White House, and the return in those years was negative. Since President Obama is in his third year of the second term, and the Democratic president is currently outnumbered by Republicans in both the Senate and the House of Representatives, there's a chance that the market will not perform very well based on very similar circumstances. Finally, even if you think that the U.S. stocks are overvalued, there's some good news. Unless you are in a strategic rotation type portfolio, we typically would not invest all your money in the U.S. stock market. Because of the divergence in growth prospects between the U.S. economy and other regions of the world, we see some opportunities overseas. Looking at emerging markets in Europe, we see that valuations are much lower than the S&P 500, making them look cheap in comparison. And of course, most of our portfolios would also include some fixed income or bond holdings, along with perhaps alternatives as well. All this is intended to diversify away some of the market risk from your holdings. We're a firm that looks at the global picture, and despite domestic bonds benefiting last year from international demand for U.S. assets, we already discussed that interest rates may rise and may cause a problem for U.S.-led fixed income. However, we are moving into that rising interest rate environment soon, and when those rates go up, the bond prices will go down. The new interest rate environment makes us cautious about investing in certain types of bonds, particularly long-term bonds or mutual funds that hold them. However, the interest rate picture is quite different outside of the USA. Note that in Europe, interest rates are heading lower as the European Central Bank tries to stoke economic growth. Australia and Canada are in a stable interest rate environment. So while we are currently holding predominantly domestic fixed income, we do have the world available when we need it, the world of bonds available as we might need it. So in summary, let's take a look at what the global economy might do this year. Based on some analysis done by the team at Oppenheimer Funds, they think the economy can take one of three paths in 2015. Stagnation, moderation, or expansion. So the economy could stagnate and grow below trend. And for all the reasons discussed, we think the probability of this is low. However, if the economies of our major trading partners in China and Europe collapse, or if the credit market seizes up, we could see the economy slow down. 2, it could expand rapidly if a number of things come together, like a sudden consumption boom in China, stronger consumer spending in the U.S. boosted by lower oil prices, or if major financial reforms occur in Europe. And lastly, it can grow moderately, in which case we see increased corporate earnings growth, but inflation remaining tame. In the opinion of the economists at Oppenheimer, this third way is the most likely. A strong U.S. dollar will likely support growth in emerging markets and other economies that the U.S. companies do business in. Central banks overseas will probably pick up where the Fed left off and inject liquidity into their global economies. However, weak economic growth in China and Europe has the potential to keep U.S. growth modest and prevent a more rapid expansion. If the U.S. economy continues to grow moderately, we would expect stocks to generally outperform bonds. However, we also expect to see divergence in growth paths where some sectors and asset classes will grow more rapidly than others, and investors will have to be choosy and look for the right opportunities. So what's the most important thing to take away from today? This: there is no single solution that's right for everyone. You cannot invest directly into an index, and you should not be invested in a single asset class or index anyhow. So we absolutely should not compare our portfolio's performance to a single index. Your personal risk tolerance, your time horizon, investment objectives, and many other factors should ultimately determine your outcomes. Nothing that we've shared in this presentation is intended to be investment advice for you. But if something we've said has raised questions, please contact us so that we can provide answers. Also, if you're a guest watching and would like a complimentary second opinion of your current investments or financial plan, please email us and someone will contact you. If you've had a friend or colleague that's currently being assisted by one of our advisors, please be sure to notate that in the email. This concludes today's presentation. For more information and timely updates, please follow us on social media or at our website. Our URL is listed at the bottom of this page. We hope that you've enjoyed the information we've shared, and on behalf of Larry and Jerry and myself, we all hope that you have a fantastic 2015. Thank you for listening.